Hello, good afternoon, traders. I hope you all are having a wonderful Labor Day. And here it's dinner trading. I just want to check in with you and see where you're at and take off from the previous video, which we just did a few days ago. I know a lot of you have questions in the idea section of the trading view, and you're kind of asking yourselves a lot why that is worth talking about, or why that is a topic of interest at this point of time. Um, what we're talking, or what we're going to be discussing about, is, or what we previously talked about, was open range breakout. And in addition to that open range breakout, we did talk about the VWAP as well, which is volume weighted average price. If you don't know what VWAP is, so we did discover, we did cover that, and we're just going to make a part two of that video today, um, which ultimately anything you might have missed in part one, we should be able to go over it in this part two. So without wasting much of your time, let's go ahead and get started here so we can see where this takes us. Anyhow, in the open range breakout, if you haven't noticed yet, or if you don't know what that means or what that refers to, is that open range breakout is a time in the day, or a time in the trading session of the day, that a market, within the first 15 or 30 minutes of the market opening, that help us to determine which side, or which direction the market is going to be leaning towards, and that allows us to decide on whether we're going to be set our trade based on a bullish strategy or based on a bearish strategy. And if you look at my screen here, I do see you will see that every first candle of every day, by every day I mean, if you trade this to be a 1 day, right here, let's treat this block as 1 day. If you treat this block as 1 day, you will see that the first candle within this block has the top, the closing and the opening of that candle has a line which is running from the left to the right, which is the right being the end of the day, the left being the opening of the day. So with that in mind, that means that if that first candle, the rest of the candle breaks above the line drawn by that first candle, that means we're going to be bullish. We're going to set our trade based on, we want those who want to buy securities will buy securities. Those who want to trade options, or based on whichever strategy you want. Uh, for example, single trade. Single option traders would buy calls in that setup. But also the reverse. The reverse is true. If you look at here, in this particular day, if we treat this day to be 1 day, which of course is 1 day, you see that we had a the day open, everything was fairly bullish, and all of a sudden we had that breakout uh, turned out to be bearish, where there was that consolidation. And I will see you. I will tell you how you can identify some of this consolidation. You can identify this false consolidation, or false breakout of the open range breakout, and be able to make a correct or right decision based on what you see. So in this chart, we have in front of us the open range breakout. Let me actually zoom this a little better so it's clearly seen. We have the blue lines here, which is our open range breakout. We have the red lines there, which is the VWAP, just on a different time frame. The red line, the blue line, and the green line here. So what we want to do is that if we break below and everything else is way above, or everything else is above that red, we definitely want to go bearish. But it's vice versa. If everything is above the green, we also wanna we wanna go ahead and go bullish. So with that in mind, um, the reason why I have this three line is that I use the top or the lower one as what we call the stop loss. As if you haven't noticed yet, or if you know what a stop loss is, a stop loss is just a risk management tool that allows you to control your risk based on, you know, your level of tolerance, or your risk tolerance level. For me, in this case, um, if everything crosses and close below a green, I will, as long as it's below the green, every pullback is okay. But a pullback that closes above this green VWAP is unacceptable. So that means I would have to close and exit position if I am participating in that trade. Same thing here. If we open and close above something and we happen to come and close below, I would have to exit that at that point where we close below. And a perfect example of those point is right here, where we close and we open and close below, you know. And here is another example where we open and close above. So you see that? So well, we did not open and close above, but we closed above anyhow, regardless. So the open range breakout allows us to capture that early morning sentiment rule. And in addition to that, we do have the um, you know we do have the VWAP just kind of giving us the confidence of for riding the trend, and along with the VWAP, we can capture that whole entire move in a really small time frame. And if you haven't noticed, I'm in my chart, I'm using a 15-minute chart, but I normally like to use a 30-minute chart. And the reason is, if you take a look here, let's take a look here real quick. You'll see that this reason that I've just highlighted here is where the consolidation is taking place. So normally with the consolidation, this is a spinning stop. With consolidation, this in a shorter time frame gives you a lot of room for consolidation, but a larger or wider time frame gives you no room for consolidation. If you see if you see a consolidation on a larger time frame, just know that for sure something is going wrong, and you really have to take your time to consider everything. So well, let's switch this a little bit to a 30 minutes time frame. And where were we? I think this is where we were before. Okay. I cannot tell exactly which one. I think it's let me go back to 15 minutes. I forgot to tell what date it was. Um, oh, this is one. Oh, here we are. Oh, never mind. All right. 7:24, and we also have it actually highlighted. Speaking of being silly. Okay. Let's reset this. Oh, there it is. All right. Here's what you need. So let's take a look at this together on a shorter, on a longer time frame, say 30 minutes time frame. If you have a 30 minutes time frame and you have a breakout on that 30 minutes time frame, it's solid. It's absolutely solid. But then on a 30 minutes time frame though as well, you will need to adjust your strategy a little bit. Now you're using the middle blue line here. You're using this middle blue line as your support level in whichever direction, or resistance level in whichever way you're trading. If you're bullish, you're gonna use this as your support level. If you're bearish, you're gonna use that as your resistance level. But generally, a longer time frame allows you to identify this consolidation and rule them out right away. Like I said earlier, this is how you can identify this consolidation and avoid this false breakout. And you see that once it broke down, we had a clear run, like a really clear run, and our exit was right there, as you can see from this other green line. Our exit was clear. um, it's not about a sprint. You're not sprinting here. You're here to take your time and be able to capture whichever thing you can capture. Like I said, we're using this blue line. If we're bullish, we're using this blue line as our support level. We're hoping that normally we would not close open or close below the blue line. If we do close below the blue line, blue VWAP here, that just means that, yeah, we have to exit whichever position that is. um, and you can use this day as a clear example. This day right here, we had no breakout at all. We had a very stupid breakout. Nothing followed really in a great way. Um, Everything just consolidated within the range of the open range breakout, which is not a great trading day at all. And this is one thing you can use the open range breakout for: identifying those weird days where you cannot make profound decisions. Unless if you're scalping on a really shorter time frame, you can scalp it on a shorter time frame. That would work well for you. But if on a longer time frame you're not seeing a clear thing, just forget it. And almost the same thing applies here, but here is a little different as compared to there. This is wider. um, Wider open range breakout is the worst. A narrower open range breakout is great. But here it's different, because even though the first one is a little wider, the ones that followed, we had this hammer here. This hammer here, if you're good with candles, which of course the open range breakout, you don't have to be good with candles. But this hammer tells you that at least you're going to be bullish for some minutes. And that, if we're identifying those hammers, we have a hammer here. You have another hammer over here, for which is of course a doji, actually, not just a hammer, a combination of everything. You have those hammer, right? So those hammers are forming up on weekdays, I mean on weak moments, and just giving you that go ahead, that go for it, those kind of thing. And then if you look here on a longer time frame, these are the kind of things you're looking for. You have a breakout, but also you have a hammer at the same time. And then, yeah, you just ride it through. You're already broken through, but you're waiting for everything to clear up. And you must have noticed everything here is followed by at least some sort of a hammer of some point. Okay. And that just makes it a lot easier and a lot simple for a lot of people. And a great example here on this day, we the narrower the length, the narrower the distance between the closing and the opening prices on an open range breakout, the stronger the market is, or the stronger the trend is going to be. And that just applies right here, what we're looking at here. If you look at this particular open range breakout, the narrower the distance between the opening and the closing price of the first candle is on an open range breakout, the stronger the trend is supposed to be or might be. And that kind of follows every other day. This is narrow here. We had a strong bullish engulfing here, which the strong bullish was followed by a strong, and everything had been just strong. But of course, remember, we have a hammer, this hammer here. We have this hammer here, which that hammer kind of tells you clearly that, all right, let's make a reverse. And I actually have a very specific tool that we can use for identifying some reversal moment. Okay, but I'm not going to talk about that in this video. I'm going to show you, although I'm going to show you what that looks like on a different chart here in a moment. Like some moments, there are moments we can capture really nicely. Which means if you miss the first session of your trading day, you can capture your second session of your trading day. And just here is another open range breakout doing its thing. But that's all. That is not important. Let me show you one thing which is really important. One thing which is very important that you should consider. Open range breakout, you can also actually, by the way, use this for identifying the trend. You can use this for identifying the trend line. If you don't know how to draw the trend line, don't worry. Let's say, for example, we want to know if this is going to stay uptrend for a little bit. you see there are corners. There are corners on every end of the day, which is right here. This is a corner. This is a corner right here, and this is a corner. This is just my way of drawing my trend. If if you have a other way, which of course the common way that everyone does it, where you grab the lower low of some point and then connect it with the lower low of another point. That all works well, which means if you're doing it that way, we would definitely, I've just turned off the indicators. We would definitely capture this moment, um, and let's say capture that moment, for example. Let's capture this moment right here. Okay, so those two moments kind of just tells us that we had a liquidity run here, and all that kind of everything fell apart up there, right around there. Same thing on the app, we would do that right over there, and just slightly hugs the line, and you'll see that everything falls in range. That's a normal trend, how a lot of people draw that trend line. But that's not how I'm gonna draw my trend line for the most part here. I have just decided to clear the chart. Let's bring our thing back. According to my way, what I would like to do is we've talked of this corner. I will pick a corner on the first, and then the corner on the fourth, or the corner on the third, but less than the fifth. So that makes me first, second, third, fourth, fifth right here. I put it right around that fifth, but then you see that every other closing day is at least closing on this line, which I can fine tune it, just something like that. And with that in mind, I still have this liquidity run, which we talked about earlier. And then from here, at this point, you see that we are in the range market. In this range market, though, what we really want to do is we want to see how we can best utilize this. I have a very specific way you can use the open range breakout on this, ranging days. On these ranging days, first of all, what I'd like to do is turn my chart into Ikenashi. When I turn my chart into a Ikenashi, I grab the lower low of all times, which the tallest wick I can see, which in this case, let's use this one right here. I grab the tallest wick, I draw that as a zone from left to right, okay? And then I do the same thing with, which in this case, it's not this, but it's that instead. I draw that and pull that to the left, pull that to the right, and that becomes my zone. But there are three steps we need to look at here. There are three things we need to look at. We also need to look at the middle zone. From the middle zone, before everything fell apart, we had the lower, or we had this neutral zone here, which was the consolidation zone. Let's consider that consolidation zone as well, because that might be our most common point for market opening, price opening, and also some days reversal point. So we have that zone. So with those three in mind, let's take a look at how we would trade these days. Let's make everything just a normal day. So, for example, the market opens within the consolidation zone, which is just where everything else consolidate on every other day basis. Um, we break below that, but notice how close we open above towards that. That just gives us the ability to know that we will be bearish. And when we get bearish, we know that when we hit this zone here, we should exit. This should be your take profit target zone, and should be bearish again. I mean, should be bullish again. And when you hit the upper zone, you should take profit. So with that in mind, if you have questions, just leave it all in the comment, and I will be happy to cover everything up for you, or answer back to you. So yeah, this might be not a long video, but we don't want to make it longer than it is already. So with that in mind, at this point, we would expect this to have a pullback if it's not going to break up to the uptrend. So at this point, we're already in the zone.